So we talked about if somebody that's freshly starting, you said the sweet spot was 3 to 5 years, but they need a business license. So, sometimes they might need funding for different things, so let's say for instance, they need a mortgage and they need money for inventory or something like that. Like, what type of advice or suggestions do you give for someone in that situation?
I mean, you're just referring to like a commercial line of credit.
Yeah.
Yeah. So like, there's two aspects.
Like their new business and
Yeah.
hey, I need a brick and mortar, but I'm also
Yeah.
going to need a little bit of money for this as well.
Yeah. Well, I mean, probably the easiest thing, in the short term is probably, business credit card.
Okay.
That's probably the easiest thing. It's probably the easiest thing to probably, qualify for. Obviously, you're having to, pay that on a monthly basis. And so,
Yes.
Ideally, you would like to be able to, pay that off each month and growing that. But obviously, there's another product, just getting a business line of credit.
Okay.
And so that's more of a short-term product. We've talked about, acquiring a piece of property, a building, or doing a construction loan to build a building. Those are long-term transactions, long-term products. But a business line of credit is a short-term. And, that's either secured or it's unsecured.
Oh, okay.
And so, secured is just, something that, a customer or borrower pledges in order to obtain the business line of credit. And that can be in the form of real estate, which allows you to have a longer maturity, or, it could be unsecured.
Okay.
So where it's not tied to any specific asset. And so, those transactions are typically, 12 months in a shorter span, but obviously it's a little riskier. So the rate may be slightly higher on something like that.
Gotcha. All right. So they can come in and get that business line. All right, cool. So let's talk about construction loans.
Let's do it.
I have someone, they call me up and I tell them how much the property costs and they say, I can build it for cheaper.
Can you now?
I love the smirk. There you go, because we both know it's probably going to come about the same.
Yeah.
And it might come out more because once you finish adding all the bells and whistles, all the finishing. So let's get into construction loans. Let's just be honest, because we're going to keep it real for the people who are actually asking me this. If we're going to keep referring to the person that's just starting out, they have not hit that sweet spot of 3 to 5 years, right? But they think in their mind, it's going to be cheaper and faster for me to build it. What advice or tips would you have for that person that has not hit the sweet spot in growing their business yet, but they have this great idea to build from the ground up? And it's going to be cheaper than buying.
So they haven't hit that 3 to 5 year. So they haven't got to the point where you're like an ideal candidate. It's just something to shoot for. Yeah.
You be the bearer of bad news and not me.
Not going to happen.
Okay.
No. Just, kind of what we've discussed, like previously, just knowing your financials, knowing what your business is generating, and having an idea of what you're able to put back in order to make the project a reality. And so putting back means, providing the capital in order to put down, for that down payment. And so having that and being prepared to put that, having a plan in place so that you do know that when you do arrive in that 3 to 5 year period, that you're prepared, to put in that capital.
I think you hit on something. For me, it was inadvertent. The ability, like if they haven't really grown the business, they don't really even have the capital or the money to do the down payment.
Yeah.
Okay.
Yeah. I mean, doing a commercial, construction line, to build a building, typically, that's it's a riskier transaction.
Exactly.
Right?
Yes.
Because you're building something that's not there. So the bank wants to make sure that that's going to get done.
Yes.
So you want to deal with people that have done that before, that are seasoned, that are veterans in their industry.
Thank you.
Yeah.
I've said that, and it's always better and it's different when it comes from someone else, because I've said that, and it's kind of taken like, oh, well, you don't want to help me, and that's not the case. It's just based off of...
You want them to grow.
Exactly, the right way.
You want them to get there, but they're not there yet.
They're not there yet. And that's why I have relationships with lenders where they can talk to you and create a plan, a business strategist where they can talk to her and create a business strategist, a growth strategy to see where these numbers lie. Okay, so let's get into the construction loan itself. Like, what does a borrower need to do to qualify for a construction loan? What's And then we'll get into the details of the construction
I mean,
loan.
you know, the main things you gotta have, I mean, you gotta have financials, you know. you have
Okay,
to have-
same thing.
You know, same thing, you gotta have good credit, you know, the down payment part of it, you know, that's gonna be different based on what you're building.
Okay,
you know, what the
okay.
asset, what the property type is gonna be. So, you know, that's all the same. Now, how the loan is structured
Okay,
is entirely different.
okay,
So like if you were to, you know, let's just say you're gonna, you know, buy a piece of property, bare land, gonna construct a commercial building on it, you're gonna start from scratch. You know, you may be looking at a 12 to 24 month period, right, to construct it.
I think I'm just gonna start three-weighing you.
Yeah, let's do it, let's do it. Tag me in.
Let me get Ross on the phone so
Yeah,
he
yeah.
can tell you all this.
Yeah,
Okay,
yeah.
okay,
So you're gonna do that from, you know, a 12 to a 24 month period. That's likely gonna be for the, you know, for the bank, you know, you're gonna try to align that with the construction period, but in a way that once they're done, based on what the asset type is, say they have tenants, and it's an income producing property, you know, that they're able to get that property leased up and earning income, and to the point where, you know, they're able to repay that once the P&I starts. And so that
tell the people what P&I
P&I
is.
is just principal and interest.
Okay.
So, once, you know, you have completed that construction in 12, you know, 18 months, but maybe you have an interest-only period for 24. Yeah.
So interest only during the construction
Interest-
period.
Interest only from the, you know, the construction period. And so you may not know this, but when you do close on a construction line, depending on if it's purely a construction loan, say your loan is $1 million and you haven't drawn one penny out yet, you know, obviously you're not gonna be being paid interest on that until you draw the money out.
Gotcha.
But once you do draw that out over a period of time, you have a draw period, say it's 12 months. Once that's over with, you know, your P&I, you know, will start
Okay.
based on, you know, what the bank, you know, your banker establishes. And so, you know, at that point, you know, your loan is gonna be calculated, you know, your payment's gonna be calculated on an amortization period. And on buildings, you know, you're looking at 20 to 25 years. You know, maybe you wanted it less, but, you know, 2025 is a pretty standard amortization
Yeah.
period. But yeah, you know, you're gonna have inspections along the way that makes
Yeah.
it unique. You know, even before you even get to the point of constructing, you know, there's planning involved. You know, there's architects, there's contractors, you know, there's plans, there's legal.
Environmental surveys.
Environmental, absolutely. And
the word.
And sometimes they find things.
Yeah.
And it's not just, you know, it's not really for the bank, it's really for the, you know, it's really for the, you know, the customer. So that, you know, yes, there's risk associated with buying this property and finding things that you don't know until you do buy.
Yeah, and having that extra reserve to now
Exactly.
deal with whatever the
Yeah.
contamination or whatever is.
And just having like a little bit liquidity, you
Okay.
know, during the construction period. So, you know, let's talk about overages. You know, most,
Okay.
you know, construction, you know, loans, they can't go over, you know, and so.
Oh, so you can't come back and say, hey, I need $1,200,000.
Well, there's some things that are unforeseen. And so, yeah, and, you know, they may have to come back. And obviously, yes, if there's more work, there's more things that go into that project.
Okay.
Then you can have it reevaluated to see if it appraises for more
Okay.
than it originally did, based on more improvements that you did during the
Gotcha,
construction.
okay.
But as a backup, it's always good to have more liquidity in case, you know, the appraised value doesn't change. And so at that point, you know, your property is under collateralized. And so from a bank's perspective, you know, that's, yeah, not good. You know, it's not good. So, but yeah, the construction line, it's very similar to qualifying in the same ways of getting a traditional commercial purchase or commercial building that you're trying to finance. But basically the structure is a lot different.
Gotcha.
Yeah.
So now the business is open and now it goes into the P&I, principal
That's
and
right.
interest. Okay,
Yeah,
sounds pretty simple.
it is. But it's a marathon though. It doesn't happen overnight.
Yeah, building, yeah. That's tough. All right, thank you, Mr. Ross Deal.
Yeah, the real deal.
See, we're coming up with taglines
Yeah,
just
that's
left
right,
and right.
that's
Just
right.
hit about the park.